Sure, thanks, Don. Before we get started, I just want to remind folks that this is a public meeting of the PGW Retirement Reserve Sinking Fund Commission, and it's going to be conducted as a virtual meeting using the Microsoft Teams conference platform pursuant to Section 21-1503 of the Philadelphia Code. The meeting's being recorded, and the recording will be made available to the public online on our website within 10 days. By joining the meeting, please note you consent to such recording. Please also note the meeting software will log the email address and/or the telephone number you used to join the meeting, and as such, that information you used may become part of the recording made available to the public. And with that, I'll turn it back over to the chairman.
Thank you, Christopher. It's my pleasure to call this meeting of the Sinking Fund Commission to order. The first order of business is the approval of the July 2022 investment minutes. Is there a motion?
I'll make a motion. I'll second the motion.
Motion has been made and properly seconded. All those in favor say aye.
Aye.
Aye. Motion approved. Second order of business is the review of the plan of the annual actuarial report. I'll turn it over to Chris for that.
Sure, and I'll, can everyone see it up on their screen? Share screen?
Yes.
Okay. This is the annual actuarial report and review. We have Joe Romanis and Al Johnson here from Aon. I'll flip through the report as they go through it. Obviously, the commissioners or their designees should, interrupt, jump in at any point with questions or comments. Just a reminder, this report is still in a draft form, pending any comments or changes that may need to be addressed following the meeting today. And with that, I'll pass the baton over to Joe and Al.
All right. Thanks, Chris. Good to be with everybody today. Good to see everybody. We're going to walk you through the July 1, 2022 actuarial valuation results for the PGW pension plan today. We'll go through in some detail. And again, as Chris mentioned, please stop us at any time with questions or, if you feel like, you want to make some modifications in anything in the presentation, we can take that back and do that before we issue a final signed version. So Joe, I'm going to kick off the report. Joe's going to take a chunk in the middle, and then I'm going to finish up with you when he's done his part. So Chris, I'm going to jump right to page 1 of the report. If you could scroll there. Some of the stuff we can always return to that at the end, but I think we'll just get sort of right into the results here. That's perfect. Thank you. So here's to kick it off, we're going to give you a snapshot of the census data as of July 1, 21 and compared to 22. And as you can see, the active participants continue to decline about 5%. This is due to the pension choice that incoming new hires have at PGW to either join the defined benefit plan or to join the defined contribution plan. And what we've been seeing is roughly about 57%, I think maybe this year, 57% of new hires elected to join this plan, this defined benefit plan, with the other 43 going into the defined contribution plan. So over time, we're going to continue to see a gradual decline in the active participants in this plan as we're going to have less joining. And then, of course, we're going to have folks retiring and, leaving PGW with a vested benefit. So retirees and terminated vested folks, just normal fluctuations there. Retirees are generally going to increase over time as the population matures. Total population decreased about 1%. Again, just normal sort of fluctuations in a plan that has this pension choice feature. Total payroll declined about 0.5%. Average pay increased about 4.5%. So again, we're going to see a decline in total payroll over time as more and more folks elect to go into the defined contribution plan. So that's just going to be a natural sort of decline over time. Average age and past service, just normal fluctuations based on the different demographics this year compared to last year. Chris, if you can flip to the next page, please. Okay. Just maybe go up a little bit so I can't quite see the top. That's perfect. So our normal cost for this year, about 7.7 million, and the normal cost is the value of 1 year's benefit accrual. So you can really look at that as a current compensation cost, similar to salaries and other fringe benefits that PGW provides for its employees. It's about a 2% decline over the prior year. Again, we're going to have a natural sort of decline in that normal cost as the number of actives in the plan continue to decrease over time. Our funding policy is to contribute an amount equal to the normal cost plus either a 20-year open amortization of the unfunded liability or a 30-year closed amortization of the unfunded liability. So the 20-year open, which is basically just looking at the unfunded liability as of the valuation date, amortizing that over 20 years, has been the larger of the two contributions for, I think, since this policy went into place. So about 26.1 million this year. As a percent of payroll, roughly the same, again, just normal fluctuations year over year. If we go down a little bit, I just want to tell you a little bit about how we got to the 26.1 million this year. So last year when we did our valuation, we were projecting to have a policy contribution of approximately $23 million. So we ended up at 26.1 million this year. So what were the factors that were involved in that change? Well, first, item B is investment returns. Obviously, from a market value perspective, the plan underperformed the 7% assumption that we have in place. It was a very, very difficult year, obviously, in the markets. We do use an actuarial value of assets, which doesn't take the full impact of that reduction in any 1 year, but spreads that out over a 4-year period. So even though we did have a fairly significant decline in the market value, the actuarial value of assets did not suffer as much, again, because we're deferring 80% of that loss that we incurred in the year ending June 30, 2022 into the next 4 years. And that'll work through the actuarial value of assets during that period of time. But at the end, even with that, the smooth value of assets or the actuarial value didn't perform as well as we would expect. And that increased that policy contribution by 2.3 million. So we started out at 23 was our projected number. We added 2.3 million on for the underperformance of the assets. Item C is we had some demographic changes because we have a set of actuarial assumptions that we use for the plan. We compare them, those assumptions, to what actually occurred during the year, and we're never going to be spot on. If we are, it's just an infinitely small chance of actually hitting our assumptions exactly right. We had a relatively small demographic loss this year of about $9.7 million. That was primarily attributable to we had more people retiring when they hit the 30-year level, which is a full benefit. More people retired at that 30-year level than we anticipated. So that actually increased the liability about 9.7 million and increased the contribution, the policy contribution, by 0.7 million. Finally, on line D, each year we update what we call the mortality projection scale. So that gives us, we use a base mortality table, and then we use a projection scale to look out into the future and estimate changes in longevity in the future. And this year's, these are published annually, and we bring them into the valuation annually after they're published. This year's scale actually showed a bit more longevity than the prior years, and that contributed to about a 0.1 or $100,000 increase in the policy contribution. So adding those three pieces together there from the 23, with those changes, you get to the 26.1 million policy contribution for this coming year. Any questions on that? Any questions at all? Okay, so even though we did see again a significant market value decline this year, it really is not having a significant impact on the policy contribution outside of those deferred losses, which will get again worked into that asset value in over the next 4 years. Hello?
Yeah, you're still there. I think you froze for a moment, but
Oh,
you're
was that
back.
me? Could
Yeah.
you hear everything?
We heard up to the deferral over the next 4 years, I believe was the
Yeah, I
last
think
thing
that-
we heard.
Okay, and then it was just we were going to go to the next page. Okay, and if you just move to perfect, Chris, that's good. Here's a summary of the some of the liabilities of the plan. The unfunded accrued liability, which is that measure that we amortize to determine the contribution, went up about 0.5%. Again, not a significant increase. The smooth value of assets contributed to keeping that under control or not increasing as much as it would have had we been using the market value of assets for that factor. The present value of accumulated vested benefits and accumulated benefits, what those are is that is the value of the benefits just strictly accrued to date by the employees and the retirees and the terminated vested folks. Increased about 1.5%. Kind of generally, that's sort of a normal progression. Those numbers are really used for the trust accounting. So the financial statements that are issued for the plan trust, those numbers are those numbers go into those reports. They're not really used specifically in determining the funding requirements of the plan. Okay, if you could just maybe move down a little bit, Chris, there. Oh, did that. Perfect. Okay. So section 2 is showing how do we get from last year's actuarial accrued liability to this year's. And what we're showing here is we were at 792 last year. That number goes up by the normal cost. So that's the 1 year increase in liability due to benefits accruing. The interest cost, which is just the interest on that liability, that's 792, reduced by benefit payments. So benefit payments defease that liability over time. And we had an expected liability of about 795,000. As I explained on the previous page, we had that demographic loss, which is primarily due to folks retiring earlier than our retirement assumption would expect them to retire. And so when they retire earlier, the liability is higher for them, especially when they're going out with an unreduced benefit. And that increased that liability by about 9.7 million. The change in the assumptions was strictly the change in the mortality projection scale from the MP20 scale to the MP 2021 scale, 1.4, increasing the liabilities about 11 million to arrive at our actual accrued liability at July 1 of 2022 of 806 million. All right, if there's no questions, we can move to the next page. Here's a snapshot of the plan assets as of last year and this year, and you can see, we had a very big increase in the assets from 2020 to 2021, and now we've sort of given all that gain we had in the year ending in 2021. We gave that back up in 2022 with the market losses, roughly a reduction of 16%. However, our actuarial value was able to eke out a 2.2% increase over the prior year. And again, that's due to that smoothing of 4 years of investment gains or losses. And it really, I think it demonstrates why we use that. We see significant fluctuations or what can be significant fluctuations in the market value of assets year over year. But the actuarial value of assets is a much less volatile number year over year. So that's what we use to develop the contribution, the policy contribution, keeping that number more stable than it would otherwise be if we use the market value of assets. So, it gives more predictability in budgeting for contributions, and just that predictability in the contribution level year over year. All right, if you can slide to the next page. I think we can pass this. The discussion, I've pretty much gone through most of that. On this page, we're showing similar to what we did with the actuarial accrued liability. We're showing the beginning of period assets, market value of assets, what came into the plan. There's the $30 million. We've been contributing that above the policy contribution each year. We've been doing that 30 million now for about 3 or 4 years. That does need approval by the city finance director. Employee contributions coming in, and then that investment return, which was negative this year due to the decline in the capital markets. So unfortunately, receipts were negative 49,000. And then disbursements, benefit payments of 58,000, administrative expenses for a total of 58.7, and the net of those gives us a market value of assets of roughly 566 million as of July 1, 2022. And then down below is the current asset allocation and the target allocation. I don't know, Chris, if these need to be updated, the target allocations based on any changes that may have been made by the commission from the last valuation date in 2021.
I can send you, or you can pull the most recent IPS off the website, but there hasn't been any significant changes, addition of alternatives or anything of that nature. Okay,
very good. And then the annual rate of return that we calculate. This may be a little different than what Alex calculates. We just have an actuarial method that we use to determine rate of return. And then there is our assumed rate of 7%. And that assumed rate, Joe had done a little bit of research. That 7% is sort of a median rate for public sector pension plans right now. So we can send you that information that we have on that, but I think the 7% we're using a rate that is right where we should be about based on the current allocation of assets and expectations for returns for the future, returns and volatility for the future. All right, if you can go on to the next page, Chris. Here is a summary of the development of the actuarial value of assets. So I'm just going to walk through this. We have our market value at the beginning of the year, the expected market value at the end of the year, which was 692 million. We ended up at 566 million. And that difference, that investment loss of 127 million now, is going to be amortized over a 4-year period. So instead of recognizing that entire $127 million loss, we're only recognizing about 26 million of it. We're deferring the other 101 million that will be slowly brought into that value over that 4-year period. Also showing there is our last other 3 years of investment gains and losses and how much that initially was and how much is left to be, how much is left deferred. So the net of those amounts is a negative 42 million. To develop the actuarial value, we take the actual market value and subtract the amount deferred. And that's a negative amount, so it actually increases the actuarial value of assets up to 608 million. That actuarial value of assets is constrained to be no less than 80% of the market value or greater than 120% of the market value. You can see from lines 6 and 7 there that the 608 is squarely in the middle of that, and leading to the actuarial value being about 107.5% of the market value. Okay. Any questions on that? I believe the next page, I'm going to turn it over to Joe to take you through development of the policy contributions, as well as the projections, some of the history and some of the projections of those contributions.
Yep. Thanks, Al. Hi, everyone. It's good to be with you this morning. So on to page 8, we have an overview of some of the information from the valuation results. And these are broken out by participant status. So you'll see the column categories here. We have those who are retired. So these are participants who are receiving benefits. We have the vested terminated participants. So these are individuals who are no longer actively employed at PGW, but have not yet commenced their pension benefits. Generally, it's people who have left employment, but aren't yet old enough to start their pension. And then actives are those who are actively employed at PGW. So the first row there, number of participants, Al had gone over this earlier. About 30% of participants are currently active, with about the remaining 70% in the inactive status. Next line down, we have the projected annual benefits. So this is what we expect annual payments to be to participants from each of these categories, either currently or once they go into retirement status. So you'll see that totals a little under 201 million. In row 3, we show the present value of those benefits. So if we take what we expect to be paid out to participants over their lifetimes and then discount it to today. When I say today, I mean July 1st, the start of the plan year. Discount it back to today at the plan discount rate of 7%. We get about $919 million. And a portion of the active benefits are attributable to benefits that are yet to be earned. So benefits that will be earned as they continue employment at PGW. And so that's about 112 million of that. And so as we reflect that down into row 5, we have what the liabilities that have been accrued as of today. And so that totals $806 million. We compare that to the actuarial asset value, that smooth value of 608 million. And we get to our unfunded accrued actuarial liability on row 7 of $198 million. So this is the difference between the present value of cost of the plan, the liabilities, and our smooth value of assets being reflected for the calculations. So another important piece of information developing the contribution is the normal cost. So this is the portion of benefits expected to be earned over the next year as employees work an additional year. So that's about $9.5 million. And as Al had mentioned, some of the participants, generally those who were hired after selected dates in 2011, contribute 6% of their pay into the plan. So these employee contributions are expected to total about 1.7 million. And so we'd say that is the employee portion of the normal cost. And so the resulting net of row 8 and 9, we get the net employer portion of the normal cost of $7.7 million. All All right, so those numbers are used for the next page, going into page 9, the development of the contribution policy. So Al mentioned earlier, the policy is based on the normal cost of the plan, plus the greater of those two amortization schedules. So one being a 20-year open, the other being a 30-year closed amortization period. So we show the development of that here, starting out with that employer portion of the normal cost of 7.7 million. And we add to that the amortization payment calculated under each of the methods. So under the 20-year open, that annual payment is about $17.5 million. So adding those two together, and we get a contribution of 25.2 million there on row 3. And that's reflected as of the beginning of the year. As contributions are generally made throughout the year, generally on a monthly basis, we reflect a mid-year timing. So often what we'll present as the figure is there in row 4, which really reflects half a year of interest, as contributions are really made throughout the year and balance out to that mid-year timing. So the number that we'll often present here is that $26 million there in row 4. So then we'll compare that to the 30-year closed amortization period down there in the bottom section of the plan, or of the page here. The development there, you'll see same amount of normal cost at 7.7 million. As we scroll down a little bit more, we have the contribution that's developed. So adding to it under the 30-year closed policy, totals to a 24.1 million at the beginning of the year, or a mid-year payment of just under 25 million. So for this year, and as we have seen and will expect to see over the next few years, the 20-year open policy is the greater amount. And the general idea between these concepts are the 20-year open period will generally be higher over the first 10 to 15 years that these policies are in place, with the 30-year close then taking over after that period. That would be generally be the higher amount. So a lot there. Any questions? All right. So if we go to page 10, a little bit of a visual here representing that. So we have the side-by-side of the 20-year and the 30-year policies. Really what's attributable for the unfunded amortization. So that's shown there in the blue portion of the rectangle here. The red portion is that employer normal cost, and the green sliver at the top represents that half a year of interest as we get to the mid-year timing. All right, turning to page 11. So here we show some figures for the actual present value of accumulated benefits. So this is under ASC topic 960, and as Al had mentioned earlier, it really is for trust accounting information. So the liability calculations shown here are a little bit different metric. Generally, they're compared to the other liabilities shown for the funding purposes, really reflect what our benefits truly earned and accrued as of today. There's no projection of salary or any service generally shown here. What we do present is based on a market value, so there is no smoothing of assets as shown here. So as we go through section 1, you'll see the total liability shown of 741.7 million. Does represent about over 1% gain increase from the prior year, generally as expected as the plan matures and progresses. Compare that to, in row 2, we'll show what are benefits that have been earned but are not yet vested. So this would be attributable to participants who do not yet have the minimum years of vesting. So really it's been earned, but those colleagues, if they were to leave prior to hitting that vesting period, would not earn those benefits. So adding together into row 3, we get the total present value of accumulated plan benefits being $760 million compared to the market value of assets in row 4 of $565.7 million. This leads to a deficiency of net assets, so really the difference there of about 194 million. And then finally, in row 6, we do show the participant counts. So these are the active participants who is vested and who has not yet hit that vesting period. All right, if no questions there, we can head to page 12. So here we show what is estimated to be the benefits being paid out from the plan over the next 10 years. So here in the second column, the expected annual benefit payout during the plan year. So you can see there in the first year of $61.1 million. That's what we expect to be paid out in pension benefits based on our valuation assumptions and the plan demographics. You'll see over the 10-year period that grows to about $64.5 million. We layer on some comparisons here for each year, what we expect the PGW contribution to be projected out over the 10-year period based on our valuation assumptions. So you'll see for the current year that is about $26.1 million. There's an additional portion for the expected employee contributions. So there that starts out just under 2 million and in growing over the 10-year period to a little over $3 million. And there is the final column, expected benefits paid from plan assets, is the resulting difference, really what would the additional benefit payout amounts that aren't covered by the contributions. So these would be paid from the plan assets, generally covered by a portion of the expected investment returns of the plan.
Joe, I do have one question. The projections going out to 2031 on page 12, the expected PGW contribution during the plan year. As Al indicated earlier on page 2, there were some demographic changes that increased the accrued liability by 0.7 million, or I guess $700,000 based on that. Are these projections on page 12 adjusted for possible demographic changes, or are we looking at that as an outlier? What can you tell me about that?
Sure. So these projections are based on the July 1st, 2022 plan census. So the items that Al had gone over on page 2, those are reflected here. And then we project out based on our valuation assumptions. So as you'll see later in the report, we have assumptions for when participants will terminate, will retire, the type of benefit they'll elect, as well as our mortality assumptions, so how long we expect people to live. To the extent that there are deviations in the experience of the participants over that period, that would change the projections. And that is expected in an actuarial valuation, right? So often there'll be differences year to year. Our goal is over the long term that those deviations would generally net out to as close to 0 as possible. But right, year to year, we will see those deviations, ideally small deviations.
So I understand all that. And my question really is how reliable how confident can we be in the reliability of these projections? That's really my question. I understand the process.
Sure. Well, no, we did do a comprehensive experience study 2 years ago, reviewing population experience, how people are retiring, how they are terminating, information based on that. So we have recently incorporated updated assumptions based on experience from participants. But as far as going into the future, should there be shocks if we see, another pandemic, as we have these black swan type events, right, there could be deviations from those assumptions.
No, I get it. And the experience study turned out to be incorrect last year, right? Because the demographic changes were more than expected for retirement. So that's all I'm getting at is that,
Yeah.
what's the level of confidence that we should have in that? I get it.
Sure.
Fran, I think we have a pretty strong level of confidence in those assumptions. The pandemic really did change some patterns of people with respect to retirement, looking for new jobs. So we implemented those new assumptions right before or during when the pandemic was taking place. So we would hope, as the effects of the pandemic sort of wane, that our assumptions will be come a little bit better into alignment with actual experience. So,
That makes sense because we've seen the same thing with the municipal fund. That's why I asked whether you thought it was an outlier or not. And I think it probably was the number of retirements. Yeah.
I would agree. And it was interesting because it was folks. Most of the folks that left early were those that had hit the 30 years, and that's when they get a full benefit entitlement and they retired.
Yep.
So I mean, I think it was just folks got there, and for whatever pandemic type reasons they may have had exited at a much greater rate than we would have anticipated in normal times. And I think we're going to get back on there, and that assumption study we made some comprehensive updates to the assumptions based on the prior experience of the plan, and we would anticipate that they're going to be pretty tight assumptions as we go forward in a more normal environment.
Yeah, and I know there's no guarantees in any of this, and I understand that. I'm just, from my perspective, sitting as a designee for the finance director, I want to make sure as much as I can of the adequacy of that $30 million contribution going forward. So, and with a change in administrations coming, we don't know where that'll end up. So that's the reason I asked the question.
Yeah. And I think before the call's over, that is something that I think we should address, Fran, is are we going to look to continue that $30 million contribution this year and, potentially into the future?
The answer is yes. I spoke to the finance director yesterday, and he's good with that 30 million as long as, assuming that Joe Golden and the staff has accounted for that amount of contribution.
Okay.
So yeah, the answer is yes.
Okay, good. That's good news.
Al, just real 30 seconds. Can you just highlight the reason for the large jump in expected benefit payments? I think it's between 25 and 26. It goes up about 2 million. We go from 26 something to 28 something, I believe. Is there a wave of retirements or demographic reason that kind of jumps up all in 1 year like that?
Joe, is that the actuarial value of asset, the changes in the actuarial those losses are dropping off the actuarial value of assets? Joe, you want to describe that a little bit more?
Yeah, absolutely. I'll take that one. So generally what we see with that jump between 2025 and 2026 is attributable to the final year that there is any smoothing effects of this past year's investment return. So with a strong performance in the markets 2 years ago and kind of offsetting last year, those impacts really are not felt until that final year, with the final year of the smoothing of last year's investment losses.
Yeah, because on a go forward basis, we're assuming that we're going to hit the 7% going forward. And so there won't be any additional asset gains or losses in the future. And essentially what will happen is the market value of assets will equal the actuarial value of assets.
Okay, thank you.
Yeah, great questions. All right, if nothing else, we can move on to page 13. section H, where we show a historical look at the funding progress of the plan, stretching from 2014 through this year's valuation. So as you look at the graph, what you're going to see is we start out at 80% funded and end up at 70% funded. Right, not the ideal place to be moving, but some commentary on that path. So I'll note these are based on the market value of assets in the display shown here. So no smoothing of assets. So there is more volatility that you'll see with the asset value. Over the projection period, the assumed investment return has decreased from 7.95% at the start of the period. We've decreased in sections and chunks over the years down to the 7% today. As we assume a lower investment return, that does decrease the funded status of the plan as the expected costs and today's value are increased. So as Al had mentioned, that 7% assumed return is generally in line with what we're seeing with public plans based on publicly available data out across the country. So we think that 7%, is in line with the general peers. As we progress through, again, as I mentioned, that volatility with asset markets. All right, so last year in 2021, looking at 85% funded, and that has decreased then to the 70.2%. So generally, as we look at a general trend line, we are moving upwards if you compare based on 2016. Generally, when the investment return was assumed investment return was generally closer. So moving from that about 65.7% at that time, generally trending upward in the year since.
Joe, could you explain, and I know this goes back to last year, but the dramatic 15% swing, is it because this chart is based on market value and not actuarial value? If it was based on actuarial value, I assume the smoothing would reduce that 15% swing.
Yeah, that's all right, Fran. So this is based on the the market value of assets and no smoothing. So yes, that is the primary driver of that 15% swing that you see from.
What was the actuarial funding ratio last year? Does anyone remember that? I don't remember.
I can look that up. Should I? Fran, were you asking it based on the actuarial value or the market value?
Actuarial. I mean, to me, the market value.
Yeah.
Is.
I think I
would call it minimally helpful. I think a chart like this with the actuarial value would be more helpful because that's more representative to me.
Yeah. In fact,
sure.
Yeah.
So last year was 75.1%, and this year it's 75.4%.
Okay. Yeah.
Value is actually increasing.
Because I was going to say the 118,783 number for unfunded accrued actuarial liability. I don't know. It's not. I don't believe it's representative of what the actual unfunded liability is. But that's just my take on it. I'd rather see this whole page not based on market value, but based on actuarial value. And I think it would make it consistent with everything else that we're looking at, because everything else is based on actuarial value. So that's all I'm saying.
Yeah, I mean, we could add a slide to the report and leave the market value in there, or we could just substitute it, because I think, Fran, all of our projections, subsequent projections are going to be based on actuarial value of assets.
Right,
You
exactly.
know,
Yeah.
So this is really just the one slide where, if you would prefer, Fran, we can change that to be actuarial value of assets rather than market value. And
No,
when
I don't
we
want to
do-
make the decision. I think that's for the commission as a whole to make as a decision.
Okay.
I just wanted to point out that I think this
Yeah.
page is different than the analysis we're getting on the rest of the page, which is based on actuarial
Mhm.
value, and that it kind of sticks out a little bit to me when you see 85% down to 70%. As Joe indicated, it's really 75% down to 74% roughly. So
Yeah.
it's not that big of a swing. It's
Yeah.
alarming, the swing, if you look at it, is all I'm saying.
Right. Yeah. And I think with an ongoing open plan like this, I think the actuarial value from a sort of just a finance perspective makes more sense than the market value, because you're going to ride out those ups and downs, right? The plan's going to be around. It's not in the process of terminating or where you're going to be liquidating the plan or anything like that, where you need to know what the, really what the true mark to market sort of value would be of the plan. But that actuarial value gives you that more of that long term, let's smooth out the ups and downs. So everybody doesn't get too alarmed year over year, because we know we're going to have some down years. We know we're going to have some up years. And again, that's the sort of the reason why we use that actuarial method is to take out those, and over a reasonable period of time, take out those significant fluctuations year over year. So you can, if you want to have a discussion with the commission, we'd be happy to certainly do that. That would not be a problem at all.
I think we'll communicate that to Chris. I think Don will communicate that to Chris after we discuss it. Yeah.
Okay, very good.
Thanks. Thank you for that explanation.
I think we can turn to page 14, section I. We showed some additional detail on that historical results. So really with the unfunded accrued liability, and then breaking out the contribution policy calculations and historically where they have been. So the top section includes the amortization payment amount, the normal cost, and the employee contributions, and the resulting contribution amount. Top half is for the 20-year open amortization method, bottom half being the 30-year closed method. And so over the historical look, the 20-year open has resulted in a greater contribution compared to the 30-year closed. That's what we would expect. And I'll note, kind of foreshadowing as we go a couple slides forward, we project in 2027 that the 30-year closed amortization will take over that 20-year open. All right. As we move to page 15, really a visual there comparing the 20-year open being the blue bars compared to the 30-year closed amortization being the green bars. And you'll see over time those get closer together. And again, projecting in 2027 that the 30-year closed will overtake the 20-year open. So as we look here, you'll notice really a drop there in 2020, kind of a decrease before we start increasing again. So that general decrease over the period followed by the increases into 2020 is when larger investment gains were really fully reflected. Gains from 2016 and 17 being reflected in the smooth value of assets. Then offset with the increases going into 2021 and 2022 with some investment losses, as well as the decreases in the assumed investment return, increasing the liabilities. No questions there. We can go to page 16 in section J, which is really our last exhibit of valuation calculations. So here we show a projection of the plan funded status over the next 10 years. This includes the smooth value of assets, the actuarial value of assets. Included here, so you'll see the funded ratio being starting out at 75.4%, compared to about 70% on the market value or no smoothing asset value. So you can see the projection over the next 10 years. So the more notable pieces are, as we look at the graph in the bottom, the funded ratio for the next 4 or 5 years really does trend sideways, even decreases a bit. Really, as we're kind of fighting uphill a bit as the investment losses from the past year get fully reflected into the asset value through 2026. So really, if you consider that the market value today gives us about a 70% funded ratio, and you keep that in mind, you can see we do trend up over the 10-year projection period. So projecting at the end of 10 years to be about 76% funded, and that would be on a smooth value of assets, as well as in our projections, that would be the same as the market value of assets by the time we get 10 years out. The middle column there, we have the projected mid-year contribution amount. You'll see that that starts out with this year's valuation, about $26.1 million. It does increase a little bit for the next few years, projecting that to be about 26.5, up to 26.8 million. And then as those investment losses are fully reflected in through 2026, that does increase to about between 28 and 29 million in the years following.
Joe or Al, what type of impact does substituting the 30 million for the 26 million have?
We've done some supplementary projections, Fran. I think they were included. We don't have them up on the screen here, but we included those when we sent the reports down to Chris. So we do have.
Was that the
this similar
5-page report? that you
Yes.
sent?
Yeah.
Got
yeah.
it. All right. Yep.
Yep,
Got
yep.
it. Yep. Thank
That's
you.
got the 30. One of the alternatives is 30 million rather than the actual policy contribution.
Okay. Yep. Perfect. Got it right here in front of me. Yeah. Okay. Got it. It's like,
So
yeah,
it's really, yeah.
more of a progressive effect. I mean, as time goes on, has more of a significant effect. So
Right.
2031 instead of 76, you're at 80%. So yeah, more. Okay. Thanks, Al. Appreciate
Yep.
it.
You got it.
All right, so that's really the last of the valuation calculations. Generally, the rest of the information, I'll turn it back to Al. We'll go over the demographics of the plan, the census data, as well as the assumptions and provisions of the plan.
Yeah, so we include this in here just to give you, we call it an age service scatter for the active employees. So it shows you the buckets by 5-year age bands. Excuse me, this one is retirees at the top here. My apologies. I was thinking it was the actives. So it gives you the ages of the retirees and how many years they've been retired, the total benefits in each category, and the average benefit in each of the categories. And you can see, I think it kind of makes sense that some of the younger retirees show higher average benefits than some of those much older retirees that would have left PGW when their salaries would have been lower than today's folks. So I think that's just something you would expect, to see as retirees age over, that the younger ones are going to have a little higher benefits than the olders. Okay. Shows average age of retirees, average retirement year about 12.9, and then average age is 71. Okay, if you get out a little bit here, your vested terminated folks, these are those that have earned a benefit, have left PGW, but have not retired and commenced their benefits yet. So as you get, as you get it older there, you're going to have less and less of those, because some of those folks are going to, they're the ones that are going to be eligible to come in and start their retirement benefits. So about 312 folks that average benefit about 10,000, and you would expect that they generally are going to have less service than retirees do, and their benefits are going to be lower. Okay, if you go to, yep, and here's our active age service chart, showing buckets by 5-year age bands as well as service age bands. And within those, if there's more than 20 folks, we show their average compensation within that bucket. And again, similar to like the retirees, the older folks and the more service folks, the average compensation in those buckets is going to be larger. And it's also helpful to look at this if you're doing some workforce planning at PGW, to see, how many folks are eligible for retirement right now, how many folks could go out with an unreduced benefit right now, and the impact that could possibly have on the organization if, as we saw, last year, we had a sort of an extra outflow of those folks that had the 30 years of service, and what kind of impact that could have on running the organization. So I think this just gives you some good data on where your employees stand, and potential for some challenges in the future should you have another large outflow of experienced folks who move into retirement. Average age about 44, and average service about 14 for the active employees that are in the PGW pension plan. This does not cover the folks that are in the defined contribution plan. So the active employees in that plan are not shown on this exhibit. Okay. I think you can move to the next slide, Chris, next page. And here's just, this is a graphical of the head count by service and how many have in there. So you can see a majority of PGW employees are now at the 20-year and less age service bracket, with a pretty significant drop off in the 20+ bracket. And then active head count by those service brackets down below. So that's just the physical, the actual numerical data that goes into the chart above. Okay, I think you can move. There's no questions. A data reconciliation to show, users of this report, where we started at 7/1/21 by active, terminated, vested, and retiree categories, and how the movement within those categories during the year ending July 1, 2022. Just a data reconciliation for anybody that's interested in seeing how the population moved over the past year. Okay. And then finally is section N, is a summary of the actuarial methods and assumptions. Again, we haven't had any change in those assumptions outside of the mortality projection scale being updated. Everything, all other assumptions and methods are the same as the prior year. And then in the last section of the document is a summary of the significant plan provisions. All these pages are the actual assumptions all documented. And section O is a high-level summary of the plan provisions of the PGW pension plan. And I think that covers everything that we had for you today. Again, like we do have that those supplemental projections you have in your possession as well. Is there any questions, any additional questions, or again, you can let us know if there's an interest in changing that one historical chart to the actuarial value from market value. You can let us know. we can make those updates before we sign the reports. And if you think of anything else, please feel free to email myself and Joe after the meeting if things come up or some deliberations happen after the meeting, and we will be, certainly happy to either get back on another call with anybody that would like to have a further discussion or make any updates to the report.
Okay, well, we thank you for your presentation. Fran, let me ask you a question. Should we address your recommendation going from market to actuarial now, or should we do it at the conclusion?
Whatever is your pleasure, Don. I think if we do it now, then Al and Joe would know. So that's fine with me, and that's fine. I think I would think that Al posed the idea of maybe adding the actuarial and keeping the market in there just as a reference point. I think that's probably a good idea.
That's kind of Fran. That's kind of where I would be. That we would add the additional reports, so we would have both. And if there needs to be an explanation in terms of why one shows a difference, they could address that as well.
It also might be a nice comparison to see the two side by side, to see, the market value showing that additional volatility where the actuarial value demonstrates more of that smooth progression of funded status and unfunded liabilities. It might be nice to see both of those side by side. So
Chris, in terms of making that adjustment, does that require a vote, or is it the fact that two of the three of us think we should move in that direction? Does that do it?
I don't think it has to be a formal vote. There's been discussion. I mean, I don't know if Kellen or Nick wants to add anything. There's been discussion. There's, as you said, a majority agreement. And it's more, I don't want to say it's a stylistic change because it is material, but I don't think there has to be a formal motion. Kellen, I don't know if your office felt it. You had anything to add?
I agree
Okay.
with Don and Fran. So, I mean, we could vote, it would be 3-0, or we can just.
Right. I think I think the ayes have it done. So.
Okay.
Very good.
So why don't we go ahead and make that adjustment, please?
You got it. Yep, we will do that. Yep.
Al and
Thank
Joe,
you.
thank you. That was
Thank
a great presentation and very informative. It was really well done. Thank you.
Great to
you
be
both.
with you. And again, just let us know if you have any, feel free to email us with any follow-up questions or concerns. Okay.
All righty.
All right. Thank you.
Thank you.
Thank you.
Thank you.
I think with the conclusion of that presentation, we can move forward with item number 3 on the agenda, which is July-August 2022 investment performance review.
Yep. And I've put that up on the screen, and I'll turn it over to Alex and/or Floyd to provide a brief walkthrough of the investment numbers and any related market commentary.
Thanks. Floyd, do you want to provide some updates on the market, especially given yesterday's news?
Yeah, I think, the biggest things, I want to keep it very short because I know that, you guys just finished the actuarial returns presentation. So the one thing to really consider within here would be that, if you're looking at the markets as a whole, within the markets, the one thing to note is that July you saw a bounce back, but if you look at July in comparison to August, which you just had yesterday, the market's essentially dropping about 4% overall. What that means is that, during July, you basically got a rally, more of a bear market type of rally that was based upon individuals thinking that, hey, the Fed, they're going to loosen rates sooner. What we saw from Jackson Hole, what we essentially saw from the inflation data that came out yesterday was the fact that that is not going to happen. The Fed is going to keep their foot on the brake. They're probably going to press it even harder. If you were looking before Jackson Hole, you were probably expecting between a 50 to 125, maybe 150 type of raise. You're now in the neighborhood at minimum of at least 125, maybe closer to 150, 175. So those are things to really be cognizant because right now, if you're looking at the market's essentially telling you that there's going to be more pain coming. And you're seeing it not just here, but everywhere.
Yeah, and something, I'll add to that, it was shown in the data yesterday, the big component of inflation that continues to worry people is the housing component. And I know that Floyd has brought that up here in the past. Both housing and wages, they're in the core CPI, they're stickier, unlike volatile energy prices or food prices, which we've seen come down and come up week to week. So that's further indication that the Fed is again doubling down on aggressive monetary policy. We at PFM, we have an investment committee next week, but I think like other investors, this signals to us deferring a decision to add risk back into the portfolio. Just some figures as of yesterday. Stocks are even with all the volatility, stocks were down about 4.5% yesterday. They're still up about 1% over the following week. Month to date, they're down 0.5%. And in the third quarter, they are up 5%. So we are still moving ahead from the bottom of the market, midsummer or so, but in a day-to-day, week-to-week, bumpy stock market. The U.S. continues to outpace international markets in the third quarter. We've seen, I guess I don't want to call it an embargo, but increased regulations, including a full ban on Russian oil, has added to growth fears in Europe. And at the end of the day, I think that's ultimately what we're looking at here in the U.S. is will growth remain strong enough, to help that soft landing that we're hoping for in 2023. In general, I saw some data this morning, or I saw a quote this morning from JP Morgan. The job market remains strong. Consumers generally remain pretty good. And so they're looking to see if, economic growth can stay, in that range, from 75 basis points to 1% or so.
Alex, just real quick. I don't know if this is for you or Floyd. I've talked a little bit about this with Fran and some other folks, investment managers and such. One thing that was concerning to me about the numbers yesterday was that this all occurred despite a pretty significant drop in fuel, prices, gas prices, diesel prices, etc. There's obviously a lot going on in Europe in terms of they're already, I'll call it short potentially of the supplies they need to get through the winter. With the upcoming planned cap on how much the U.S. and Europe are planning to pay for oil, there's some thought that the Russians could go as far as just pulling it completely off the market. I guess my concern is if inflation was that bad in spite of oil or gas prices coming down, let's say from 5 to 3.75, and I'm just kind of spitballing there, what happens if gas starts going the other way again? I've read some reports if the Russians stop selling oil, I mean, literally overnight, you'd see at a minimum gas go back up over $5, perhaps more. So what happens to inflation if gas prices even moderately start heading the other way? I mean, how much worse could it get in your committee's opinion?
Before I hand it over to Floyd, I do have some data. Commodity prices, as a whole continue to fall in the third quarter. Again, week to week, they can be volatile. So, again, the underlying commodity contracts continue to fall. Oil is outside of the core CPI. I think a lot of yesterday's reaction was to, the jump in core. And I talked about the housing component of that we've been speaking to. I can't speak to the impact of Europe energy markets on the U.S. Conventional wisdom last time around was that we we're relatively isolated. But Floyd, do you have anything to add to that?
Yeah, I'll give a little bit of basis in there. If you're looking at Europe, what you're actually starting to see, Chris, is you're starting to see people understanding that the cost pool inflation portion, that they're going to have to do some changes. So even if it does spike, people are starting to change the way that they're sourcing, their energy. So whether it's, via electricity, via coal, or electricity via other types of means, they're starting to switch that out within their businesses. So you are seeing that. So they probably won't pay as high as a cost as they could and or would based off of what's going on with Russia. Now, the other side of that is, if you looked at it from, the other components of inflation, the dollar is very inflationary. So the dollar being strong, the dollar being able to essentially everything's priced in dollars. The one thing I think that a lot of people do dismiss is the fact that you do see you do see the dollar being strong. When the dollar's strong, we're actually exporting inflation to other individuals. They're having to take on that inflation. And granted, that might sound like it's a good thing for us. It's a bad thing for them, because at the end of the day, for their businesses have to pay whatever fee it is in that commodity in dollars. That's why you have the currency translation impact within their balance sheet, and they pass it on to the consumer. So the consumer is ultimately the one that ends up paying for it within their economies. So that's one thing to know.
And I can't speak to Europe, but in the UK yesterday, I think the pound gained versus the dollar, primarily on that dichotomy you were talking about, Floyd. It was a relatively better news on inflation there, and again that relative, the dollar relatively weakened in the UK, or against the pound. Any broad questions on the markets?
Alex, just
yeah.
another broad economic sort of macro question. I think you mentioned employment being stable. I know Floyd has mentioned it in the past. I still remain concerned about, we've seen an increase in wages over the last, I'll say, year and a half, an increase in wages. We see a implementation of corporate tax due to the recent federal bill passed. There'll be an increase in corporate tax. I assume the corporations are not going to eat that tax. I assume that's going to be passed on to the public. We see that Goldman Sachs is laying off across the board in every single department. I saw that headline yesterday. I remain concerned about the job market going forward with all of those sort of cost pressures. And I think that the increase in wages, the increase in corporate tax is going to keep pressure on the inflationary aspects of it, because that money is just going to be passed on to the consumer, I believe. So
Yeah,
what do you, well, I wanted to know your thoughts on that. I don't have your expertise, so I wanted to know what your thoughts were on that.
I mean, and that goes back to, I think, the big question of, central bank, I don't want to say interference, but central bank action, and the likelihood of, a hard landing versus a soft landing next year.
You can say interference, by the way, because I think that's accurate.
I mean, it's not, but again, it's right. It's out of the economic playbook. I mean, raising rates will eventually get inflation in check. The question is, how hard does it impact the economy? And one of those elements of the economy is hiring, the job market. We are in a good job market. Unemployment continues to fall. Wages are high. That's a component of inflation in its own right. But like you said, I mean, I saw the report on Goldman Sachs yesterday. I think, just this morning I was reading something, that we haven't seen action yet, but more anecdotal, white collar workers you're starting to see uncertainty creep in. Job postings may be pulled. And a lot of these are in sectors where there was very, very high growth over the last 2 years. A lot of it is expected to be in the real estate market, where again, there were tons and tons of broker jobs added over the last couple of 2 years. So it's something we're going to pay close attention to over the next few months. These types of employers, whether they continue to either increase layoffs, pull listings, it's generally out of uncertainty for how long this central bank policy will remain in effect. And as Floyd was saying, the data, what we saw about a month ago, a little over a month ago, was positive, indicating that it would be a lot shorter than expected. Jackson Hole's speech changed that, and then yesterday's data, put it to bed. So again, it'll be this, continued dance. I did mention, consumers generally as a whole remain strong, but a slowing job market could change that in its own right. Central bank policy is slow, or there's a lag to take effect, and I think maybe that's what the market overlooked a little over a month ago. This time around, I don't know, it's, more sobering, or we're understanding where we are. Geopolitically, we're generally in the same bucket. There's a lot of uncertainty here in the U.S. From division. Armenia has flared up. That being said, there have been positive news coming from Russia. So, there may be some resolution to the European energy crisis. I don't think we're handicapping that at all right now, but like I said, it's we're on this tightrope act. We being the U.S. economy.
Yeah, and even putting aside, I mean, look, the recent decline in the markets, I'll call it. I mean, you went over some of the numbers. I mean, maybe over a 3-month period, there maybe increase over a 3-month period, but the recent past decline in the market, that's all without, that's what's with decent earnings. Let's put it that way. I think looking forward, the earnings may not be, as good as forecast previously. So, that's, I hate to see the markets,
well, I mean,
adding that on top. I don't know. It's concerning. It's all I'm saying.
And earnings, again, it's all relative, right? So I think earnings reports have been estimated downwards a little bit better than expected. I don't think we've seen a lot of, I think we've even seen companies continue to lower estimates for the fourth quarter. I know I've seen 1 or 2, I can't recall the specifics. Stocks are up 1% over the last week. Over the last 7 days, stocks are up 1%. In all of September, they are down, I think, 0.38%. So it is really, even after yesterday. So it is, again, very volatile. And I think that's, like I said, we've got, there's varying sets of data. Strong earnings conflict, goes along with a moderate consumer, or a consumer that is not withdrawing or anything.
A question for you guys. The railroad strike that I've been reading about, will that have any material impact on inflation if it becomes a reality?
Yes, I mean, it'll have I don't know much about the specifics of rail transport, but it would certainly have a major effect. I also don't know the specifics about the negotiations, but I have to imagine that the groups will come to the table, and the result will still be inflationary, with some kind of, higher wages, et cetera, related to that industry. Not as much as, as a total shutdown, but, we're looking at, again, just, higher wage pressures in this connected sector.
Don, just to point out that portion, the one issue is that the government can't force them to work. So right now they go strike, the length of the strike will definitely play an impact on still the supply chain issues that we currently have going on. Trucking slash transportation has already been has already been maxed out. Rail was another way to kind of be able to diffuse some of this. So with that stopping, that does create, it is a a slight inflationary concern if it goes on for an extended amount of time. And then one point, Fran, to your point about Goldman, one thing to consider about Goldman traditionally calls the bottom 10% of their employees consistently. So that's one thing to really focus on. When hearing the news about Goldman is a lot more callous in regards to the way that they think about employment.
Yeah, I once heard somebody refer to them as not having a soul, so I get it. Yeah. Thank
Yeah,
you.
we'll keep our eyes peeled for any other layoffs in the financial sector, for sure. Any other questions on the markets? This is older data on the performance page you have here, but it's as of July, the end of July. So following the strong month that we had sort of talked about. So naturally, the portfolio recovered and outperformed its benchmark. On a slight overweight to equities. There were some. Most of the active managers within equities also did well. I think fixed income, broadly active management still continues to underperform, not just in this portfolio, but in the peer universe of active fixed income managers. But again, just actually, if you want to go back up, I'll note some highlights. Again, this is a month old at this point. With the international equity segment, let's start at the top. PineBridge, misses slightly for the month, but on a year-to-date basis, continues to outperform. So they've, recovered quite nicely from the issues that they've faced. Continuing to monitor them, but downside protection it will go a long way. Copeland continues to have a volatile year, but outperforms, for the month and the trailing 3 months. Within international equity, both Acadian and Ernest continue to exhibit strong performance in good markets as well as downside protection. You can move on to the next page now. And then, the fixed income as a whole, 2.5 for the month versus the aggregate of 2.44. Slightly outperforming the aggregate year to date as well. Garcia Hamilton continues to be sort of a bright point. One of the stronger active fixed income managers in the entire, in the universe, in their peer universe. Sky Harbor, despite its its relative defensive positioning within the high yield universe, continuing to generally do well, outperform the broad Barclays aggregate in periods like this, which is what we hired them to do. But again, over longer periods, some of the the MetLife Credit, Sky Harbor, higher correlations with equities. As you can see that in the year-to-date figure for Sky Harbor. As of 2 days ago, market value of the plan, $583,743,420, with $13.5 million in cash. So I believe that figure is still up from where the plan was at the end of July. Mostly, I don't have the final figure for the end of August yet. Most likely down slightly from the end of August, given where both stocks and bonds have moved in September. But I will have that sent over to Chris with any additional commentary as soon as it's prepared. likely, either if not late today, tomorrow. That's the end of my comments. I don't know, Chris, if you wanted to add anything. No proposed changes. We do still have cash on hand. Not really proposing raising cash at the moment, but we'll continue to monitor how things develop, and we'll stay in communication with Chris regarding that, and if there is an opportunity to make any other changes. But as of now, nothing on the horizon.
No, I don't have any other commentary other than to add, the 13+ million in cash at current payout levels should take us through to the first or perhaps even to the second month of 2023. So we should not, I think it'll take us through January comfortably. February would likely be, early February would likely be the next time we would have to raise cash, or sometime before, to pay benefits. But I'm in agreement with not raising additional cash at the moment. That's all I had.
All right. Any other questions before we move to new business? Thank you, gentlemen. Do we have any new business to discuss at this point?
No, I did. The final scheduled meeting of the year is November 16th at 9:30. And that was the only item I wanted to mention on the record.
Excellent, excellent. Any other comments before we close it down? Is there a motion for adjournment?
I'll make the motion.
Second
All right.
the motion.
Motion made and properly seconded. Gentlemen, have a great day. Thank you very much.
Thanks, everybody.
Thanks, everybody.
Thanks, everyone.
Thanks, Alex. Thanks, Floyd.
Bye-bye.
All right, goodbye, guys.